Hello, Mark Ostwald from ADM Investor Services International. And it seems an appropriate week to have a little bit of a review of where markets stand relative to where central banks are. We've had the Fed, the Bank of Japan, and the Bank of England all meeting this week. We obviously had the ECB the week before. We've had the Bank of Canada recently as well. And there seems to be a certain degree of unease emerging in markets. But for my first table today, I've got a familiar one. It's the market implied policy rates, which hasn't really changed a lot in quite some time for the major economies around the world. As one can see, and as was confirmed by the Federal Reserve this week, basically no one over the next 3 years of the major central banks is expected to raise interest rates. There are some marginal expectations of some rate reductions. Amongst those, there is talk that the Reserve Bank of New Zealand might cut into negative territory. The Bank of England this week suggested it was looking more closely at negative territory. And we obviously had an interesting week insofar as a study has been published which suggests that actually negative rates are rather more problematic and less effective than actually having zero rates. Be that as it may, we've got a stable policy environment. Obviously says something quite negative about the overall economic outlook in terms of catching up after the virus impact. But how is this playing out in markets? And this is really sort of the nub of the point this week, that we do seem to be gradually getting a sense of unease. So the first chart today is the VIX volatility index. Which has come down off the plus 30 levels that we were when we had the volatility in equity markets related to tech stocks at the beginning of the month, but it's definitely elevated relative to where we were over the summer. The next chart is the Deutsche Bank currency volatility index. And I think that's interesting insofar as currency volatility has been picking up, particularly things like sterling, euro dollar, even dollar yen has been quite a bit more choppy. And I think that tells us a little bit more about concerns on the political front, particularly to do with fiscal stimulus and to do with tensions geopolitically. But I think really what we've got in terms of market reaction to this week's Federal Reserve message is a very simple one. Markets like the fact that we've had upward revisions to GDP forecasts for 2020 and 2021. However, they are basically saying, well, everyone thought things were going to be atrocious, and now they're going to be slightly less atrocious. So there's not a lot of comfort in that. Markets like also the idea that interest rates are going to remain low for a long time. But there seems to be a growing sense of frustration that we're neither getting the sharp rebound in economic activity, which is obviously coming into question, particularly with so many countries having to reintroduce social distancing measures and indeed restrictions on movement. So there's a frustration there, and there's a frustration with the fact that a lot of the central banks are saying we are willing to do more if downside risks to our outlook materialize, but for the time being, we don't really feel any need, given market behavior, in terms of low volatility, stable credit spreads, even relatively speaking, quite subdued currency rates, has been quite good. The one interesting contrast here, and it's just the final observation, is that as much as we've seen currency volatility pick up and VIX volatility pick up, the final chart is of the V2X, the Euro Stoxx 50, and it's very noticeable there that actually stock volatility has been actually very, very subdued, in stark contrast to the US, probably a reflection of the fact that there are a lot less tech stocks in the Eurozone sector, and it's been tech stocks driving the volatility in the US. Those are the thoughts for this week.